So webinar number 5 of year 2023. Very happy to see you here. My name is Melvin Lim, and thank you for joining us on this webinar on the art of real estate investment. So you will be here, I think, because you are thinking about analyzing between these 3 types of condominiums. So for today, we're going to talk about new launches versus TOP projects as well as resale condos. And I think we have something very interesting for all of us today. So just a quick coverage on what we're going to talk about. Number 1 is that we want to look for this particular concept within the 3 types of condominiums. Largely, we're going to talk about seasons of change as well as disparity effect. Number 2 is that we want to see if whether should we still purchase a brand new TOP property. And just to set the context is that for those of you who are joining us on the very first webinar with PLB, is that TOP properties relates to condominiums that has just received its keys from the developer. That means if, let's say, you have bought a new launch project about 3 to 4 years ago, and the developer and your lawyer wrote to you and saying that, hey, you can come and collect your keys right now to your brand new home, that is the stage that the property has achieved its temporary occupation permit. We call it in short TOP. And then of course number 3 is that we want to talk about whether can resale properties still see appreciation if you were to go for a resale property in 2023. Alright, quick disclaimer. Do note that property investment is a huge financial decision. Do make sure that you do your financial prudency check, your in-principle approval from the banks, and take note that PLB webinars are meant for educational as well as sharing of our opinions and research basis. So, quick question. If, let's say, you are waiting at a sideline right now, or perhaps you have just sold off your current property, or in the midst of doing a transition of selling your current property and moving to the next one, and your next target type of property is basically a condominium or apartment status kind of asset, which type should you go for? Because this year, you're going to have plentiful amount of choices. Number 1 is that there are going to be 47 new launches that will pop out in the new launch space. 38 TOP projects that will pop out in the TOP category. Similarly, these are properties that nobody has lived in before. And later as we dive in, also a quick glimpse about the amount of percentage of this kind of properties that will be sold usually in the first to second year, is that there are less than 20% of owners that have gotten their keys that will usually sell during the TOP stage of first or second year from the TOP date. So we have to look at this category having that lens that 80% of the owners right here, basically they're buying the new launches in the past to move in. So you're not going to get all these properties out in the resale market. There's only probably about 15 to 20% of such properties that will be put on the market by the first-hand owners, provided this is something that they have already planned for. And thus, there's no clear statistics here that all these properties are available on a large percentage basis. Perhaps some of the projects that are just TOP, you will only see a few listings that's available in the resale market, because maybe a lot of the owners that have waited for 4 years, they really want to move in and enjoy the new launch that they have just purchased. And of course, resale, you have, of course, choices in the entire spectrum of different districts. And today we're going to analyze charts. And talking about charts, I'm bringing Rong today with us. So let's welcome Rong.
Hello.
Yes. All right. So later I'll bring Rong back again. And meantime, so this is the first time we're going to do like a little bit like a banter series. So if you've seen our Nuggets on the Go banter episodes as well as our PLB Insights new launch banter episodes, we're going to talk a little bit about the charts in a discussion format. Are you ready, Rong? I'll kickstart today's portion with just a quick glimpse of what we'll be covering, because we have done a lot of charts, and kudos to our PLB research team. These are some of the materials that we'll be going through later, and very excited to share with you today. So first question that we want to explore is that does history always repeats itself? And in terms of real estate in Singapore, what can we learn from historical pricing as well as historical movement? So quiz time. And based on our past 4 webinars, we realized that our audiences really love to participate in our quiz. So feel free to chat in the chat box below, as well as feel free to leave your questions. And a quick glimpse of how we are going to answer questions is that we're going to tabulate all questions after every webinar, and within the next 7 days, our team will actually tabulate all the answers. We'll compile everything into a Q&A PDF pack, and then we'll send out the FAQ questions and answers. So every one of you that participated in our webinar will be able to see all the questions as well as all the answers in a very concise PDF pack. It's also available on your email that you signed up with us. So once again, thank you for signing up with us. If you have just joined us at this particular time right now, we are entering into the quiz time. Which type of real estate do you think in Singapore residential property? So we are only looking at residential properties. Which one of them, out of these three choices, HDB apartments, condo, and apartments, and namely, when we refer to this category, we're talking about non-landed residential properties. So meaning there are condos, there are apartments right here. Landed properties. Which one has a more inelastic price to supply relationship? So maybe let's take the next 10 seconds to look at which one has a more inelastic price to supply relationship. Now, to answer this, we need to have a look at these two graphs that I put up from this particular website. And of course, it's just for reference purposes. So, and inelastic price to supply relationship refers to the chart on the left. Elastic price to supply relationship is what we call elastic supply, refers to the chart on the right. Now, to sum it up for everybody, basically in economics terms, this means that when price of this particular type of asset or product increases, supply rushes in to fill up that gap. Now, meaning that when you see a price increase for a particular product, supply quickly rushes in and thus it stabilizes the price. And thus the price will then find that it needs to move in a certain time frame and season for the price to rise again. And of course, when you have an inelastic relationship, it means that wherever price rise, supply finds that it's very hard to come in, and thus it has an inelastic supply. And of course, if we talk about asset strength, the more inelastic the asset is, the more powerful is the price component, meaning that when price increases, you got to enjoy the gain if you already own this particular asset without fearing that there's going to be more supply and more competition. However, if you own this type of asset, your fear of an existing asset owner is that if you already own this type of asset, when you see that price rises, you will start to feel that, hey, I don't really get to enjoy that price rise for a very sustainable period of time, because when price just rises a little bit, supply quickly rushes in, and my price then hits a more plateau or stagnant kind of stage. And thus, if you own this type of asset, you'll find that it's very hard to enjoy the price gain on a very consistent basis. So coming back to this question is that, which type of real estate in Singapore in terms of residential space, out of these three, do you feel has a more inelastic kind of relationship? Meaning that when price rises, supply is very hard to come in. So take the next 10 seconds, maybe just answer in the chat box below, and then we'll be very happy to see what are some of your responses. Let's maybe roll the next 10 seconds. All right, so when we are talking about this, coming back to this chart, naturally, I think some of you might already have a glimpse of it if you have followed our last webinar. Basically, in our last webinar, in the landed webinar, which is webinar number 4, we talked about the fact that landed property has one of the most inelastic relationship of price and supply. Now, the core rationale is that landed property in Singapore, you only have a very fixed inventory in terms of the land parcels that is currently in the land scarce Singapore. So there's only 73,000 landed homes, and thus, of course, I'm already at the answer page. So if you've guessed it correctly, congratulations to you. And of course, if you look at this relationship, let's introduce some key terms here: elastic, less elastic, inelastic. That is, of course, coinciding with this new term that I would like to introduce to all of you, is the hardness of asset. So the hardness of asset help us to articulate the inelasticity or the elasticity of the particular type of residential property in Singapore in a probably slightly clearer manner. So in short, HDB properties are what we classify as a softer kind of asset. And of course, condominiums, there are only 340,000 of them. Of course, maybe an illustration of these two portions here. And later, I'll just substantiate with a little bit of articles. Basically, if you remember in the year 2022, we had a couple of new policies that came into the HDB space. Number one was that when there was a lot of articles talking about the $1 million HDB properties, immediately you see the introduction of the prime housing scheme that came in, because naturally it will be very unhealthy if our HDB pricing is sustained at a very high price quantum level. So when an asset is softer, it attracts a lot of government policies to come in order to curb the rising demand and to increase the supply at the same time. You also have noted that in the past couple of months, there was a confirmation by, of course, our government that there will be about 100 to 150 BTO projects that will be introduced and they'll be concurrently built by the year 2026. This is an example of a soft asset kind of configuration, because naturally, HDB properties will attract a lot of government policies on a year-to-year basis. So thus, when price increase, it attracts policies to come in to increase the amount of supply. Thus, it is the most elastic. And landed, even though price has increased, but seemingly there's a lot of difficulty that the government can increase the amount of land to fulfill the kind of supply right here, because it's inefficient for our government to increase the land for landed properties. And the rationale is because we're already so land scarce. Every plot of land is so valuable, and every government land sales will make more sense in terms of our government's direction to take care of the population growth by building high-rise apartments. So government land sales, of course, nowadays, they are 99s and they are reserved for high-rise properties, whether is it a BTO or whether is it a government land sales for private condominiums. So having a look at this from soft to hard assets, the more inelastic your asset is, the better the appreciation potential. And of course, this is an example of how softer assets attracts more attention from policies. So because of the fact that the nature of HDB apartments attracts the most amount of policies, whether from curbing demand or increasing its supply level, this is basically the conclusion, meaning that softer assets, when price rises, supply increases quickly. And of course, harder assets, when price rises, supply finds it hard to increase. And another example on how HDB apartments are, of course, increased very easily is that our government can always ramp up the amount of BTO projects to fulfill the amount of demand that is in the market. And even if we take a look at the amount of new launches this year, with 47 different new launches, and of course this year we see the highest amount of new launches because there's a combination of on-block developments as well as government land sales. With 47 new launches, the estimated total is still just about 11,000. If I were to add this into the current stock of 340,000, that would just bring it to 350,000, which would still be approximately about 20% of the overall residential inventory in the entire Singapore. Meaning that in the entire Singapore landscape, 75% of the types of properties for residential space are belonging to HDB, because there's about 1.2 million HDB, 340 to 350 condos, 73,000 landed properties. So after understanding this, why is it that we want to share on this particular context is that everything that we are sharing right now on a macro or micro basis will help us to make a decision later on the 3 different selections on whether you are going for a new launch, TOP condo, or resale. And I will come to that summary very, very quickly. So another concept that we want to ascertain is that we also introduced these 4 quadrants in the last webinar. So if you have not joined us for the last webinar, basically asset type, if we're talking about the types of residential real estate right here, is that the high growth quadrant 1 type of residential properties is belonging to the high growth but low rental yield type. So most of the time, landed properties are being classified under Q1. And of course, like shop houses, they're also being classified right here. And if I were to share with you all the different types, this is just an illustration of how we classify Q1 to Q4. So a quick illustration is that we have also talked about the fact that in the last 9 years, small condos and apartments, they have been fantastic in terms of a dividend play. That means if you have invested in small condos as a second property or your first property, you'll find that it's very easy to rent out. Rental vacancy rate is low. Usually switching from your tenant to the next tenant is fairly easy. Easy to rent out, to find a tenant. However, you'll find that in terms of performance of a quantum play, if you're looking for that jump in terms of your valuation appreciation, you'll find that it is a low growth kind of asset type. So this will also be related to some of the conclusions that we have for you today. Now, third thing that we want to share is that we'll be talking a lot about disparity effect today. And just a quick glimpse of disparity effect is that there are seasons whereby certain types of property, certain bedroom types of condominium or apartment space will be the recommended choice in different seasons. So for example, during the year 2021, we recommended a lot of our clients that Interterraces has already hit its peak pricing in terms of quantum and PSF play, and they can start to look at the next upper tier, which is semi-D segment, or they can look at the next tier, basically whether is it a strata landed, huge condominiums or 99s Interterraces, because this will be the types of properties that will have a faster movement in terms of total quantum appreciation. And usually disparity effect changes through every different season and every different year. And these are the main concepts that we'll be talking about today as well. So quick recap, we talk about the types of quantity of residential types in the entire Singapore. Of course, we will also talk a lot about white paper that 2030, we're going to see about 6.9 million in terms of population. And most importantly is that right now, out of the 340 condo units, 68,000 are being owned by PR and foreigners. Why is that important to understand is that because of ABSD, a lot of the foreigners that has already owned property in Singapore as an investment kind of asset, they are not selling them easily. They find it demotivating to sell because if they sell, they have to purchase back at the latest additional buyer stamp duty of 30% as a foreign investor. So a lot of them are actually continuing to enjoy the currency disparity as well as the rental rates that has beefed up over the last 3 years. So this amount of properties are considered a little bit more stagnant in the market in the sense that it increases the holding power of this particular type of property in Singapore, that this category of owners that has already owned properties that are technically not going to sell them, or there's no fire sale in the market from this category. And a quick recap is that by the next 7 years, we're going to see 50% of Singaporeans and 50% of foreigners. And what does this mean for you as somebody that's planning to buy a condominium is that you are going into one of the asset class which is less elastic, and thus naturally in our context and opinion is that this is definitely a good choice if you're moving from a softer asset to a harder asset. And residential supply, in our opinion, is that it is still under supply because there are 340,000. Year on year, our government is doing a great job by not increasing the supply in a very quick fashion. So they are very cautious in introducing large amount of GLS. And we see this, of course, as a good indicator in the sense that it protects the price movement as well, because by introducing a large quantity of supply, it can also flood the market with an oversupply situation. But naturally, on a year-to-year basis, based on the status of Singapore, we find that the private residential space is still in an undersupply situation. And of course, this is landed property. The supply has stagnated for the past years. So why is it important to understand the macro aspect in terms of the amount and quantity of the types of properties in Singapore? Is because by understanding the macro concept, it gives us more confidence to know what particular type of property to invest into. Of course, if after doing your financial prudency check, you find that you have the investment range to go into a landed home, and provided a landed property is a type of property that will suit your family's needs as well as your lifestyle, then naturally, by going into the hardest asset available, that's one of the key best choice because the amount of quantity is technically locked. And this amount of quantity is here to stay. Even if, let's say, there will be to be any increment, it will be in a very minute fashion. Now, something to note about this segment, which is namely the condominiums as well as apartment status, is that if you are going into this segment, you might be thinking, hey, Melvin, what if the government increases the amount of government land sales on a very large quantity on a year-to-year basis, and if there's a lot of en bloc happening? But take note that every en bloc, there's a tearing down of existing unit, there's a replacement, even though there's more quantities being created. But these owners here, they still have to find a replacement home, and the increment in terms of the difference between an old project and a new project is not. So for example, an en bloc project, perhaps in its older status, maybe there's about 500 units, but the brand new one that's being created after the en bloc could be, let's say, about 1,000 units. If you look at it on a grand scale basis and at a grand scheme of things, that's only an increment of 500 units. And judging by the amount of new launches this year, 47 new launches, but there's a lot of boutique developments because there's only 7 launches that's above 500 units per project. So that is why, even though there's 47 launches, there's only about 11,000 new units being created. And one more very unique feature is that this category here has an international audience, because not only do Singaporeans aspire to move up to a private condominium, PRs can only buy private condominium. because unless they are married for more than 3 years and they want to buy a HDB property, and provided they also don't have properties in foreign countries. So there's a lot of restrictions right here. And foreigners that are in Singapore, if they want to buy, they can only buy a condo. And of course, there's a lot of investors that are not in Singapore that are of course very interested in our private condominiums as well. So thus, this is considered a harder asset. Now, if I were to of course expand the category, you roughly then see also what I'm referring to in terms of the hardness of assets. And of course, for today's context, we're not talking about GCB shop houses. We're also not talking about Sentosa Cove landed. We're namely talking about the condominiums right here. And now that we understand these concepts, let us then apply to pricing analysis. And later, as we bring on the charts together with Rong, we're going to talk about seasons of change. And this is referring to macro analysis. And how can we use a micro tool like the disparity effect that PLB has created to apply the seasons of change and then to help us make a decision on whether 2023, should we go for a TOP project, a new launch, or a resale? And that's the answer that all of us want to walk away by the end of today's webinar. And do stay tuned until the end of today's webinar, because by the end, we're going to give everybody a QR code for you to download a freebie tool. And this is a PDF pack that contains all the comparisons of different regions in Singapore, and with that PDF pack, they will help you to make a more informed decision on which particular type of condo should you go for in different regions. And later we're going to sum it up for you as well. So moving on to our second quiz, and after this quiz we'll bring out the charts. Now I would like to ask everybody a question. Now, do you think our world is becoming more certain or less certain? And of course, every day when you see the news, whether you look at global news or you look at American news or you look at Singapore news, every day there's different macro and micro factors that's upcoming in the, whether in the financial space, real estate space, in the job space, in the economy. Do you think our world is becoming more certain or less certain? Let's take probably about 5 to 10 seconds to answer and share with us your opinion in the chat box. Maybe let's have a timer here also. 10, 9, 8, 7, 6, 5, 4. All right. And just have a look at, and let's explore some of the latest global uncertainties. And I'm not sure whether have you seen some of this latest news. We talked about this in our latest NOTG Banter series. And Silicon Valley Bank, Signature Bank, and of course Silvergate Bank, Credit Suisse being bought out by UBS. Of course, banking crisis raises fears of global recession. Of course, even among all this, there's still another round of rate hikes. Of course, we are not sure whether the Fed will pivot in the next upcoming Fed meeting. And this was actually just a couple of months back, where the latest buyer stamp duty in terms of this wealth tax is technically not a cooling measure, but more of a wealth tax, has also changed a little bit. And of course, this is the current level of stress test that the banks are applying when you want to apply for a loan. So what this means is that when the stress test is increased, technically the amount of mortgage that you can loan for your next home purchase will be very, very different. So this is an example of borrowing capacity based on stress test income. So for example, if we move along the dates and the timeline based on the current level of stress test, you will see that actually the amount of loan quantum per borrower has decreased. And what does this mean is that the opportunity and the window of opportunity for every home investor or homeowner technically has shrunk, in the sense that you now have to put in more CPF or more cash into your next home. And what does this mean for you? And of course, by understanding macro factors, how does this help us to apply it on a micro basis? Because if you have also followed us on the previous webinars, we talked about whether is it good to time the market, whether is that a best time to time the market. In Singapore, does timing the market apply to our local context? Will we be priced out? Because a lot of people has already been priced out over the past 2 years. As they were trying to time the market, they went ahead to rent for 2 years. They find that they need to extend their rental for another year. And have they been priced out from whether is it the landed or the condo market? And I think what is important to know is that our economy is getting more and more less certain. And there's going to be a growing amount of uncertainty, and we are not moving towards more certainty. We're actually moving always towards more and more uncertainty on a global basis. And thus, I think the conclusion is that there will always be endless macro factors. And what is important is that we want to see how the macro factors play out in the local real estate market. And we have this chart actually to talk about the fact that the reason why a lot of investors are flogging to Singapore even after the pandemic, and I think is because of the pandemic, is that they realize how strong Singapore is as a safe haven. And these are just the list of internal factors and benefits that we have. And our base support level of our residential properties is just so different because, for example, in US, in Australia, in Japan, close to 40 to 50% of the residents there, they rent. There's a lot of internal rental, and ownership is usually at about half of their population. But in Singapore, it's vastly different. We have close to about 90% home ownership rate, and thus our behavior in terms of our pricing is vastly different. And with foreigners that's already owning our properties, that created another different kind of demographic as well, because foreigners that are already owning our properties, they are not selling, and thus the holding power of our condominiums are increasing. And with that, a quick introduction, of course, to Rong, is that I want to bring Rong in to talk about the chart. So Rong is our associate investment consultant. He has 10 years of real estate portfolio experience helping our clients. And of course, I want to pass on this particular segment because this portion here, we're going to talk and decipher the charts together. And Rong, are you ready?
Yes.
All right, great. Take it away.
Okay, hello everybody. So, okay, before I go on to the charts, right, let's talk about how we analyze the data in the next few slides. Generally, we are only focusing on leasehold properties today between 99 years to 110 years. And we are splitting them into the different regions in Singapore. So how URA actually we classify the entire market into like 5 different regions. So we have the Western, Northern, Northeastern as the Eastern region. So this one generally we classify under the outside central region in terms of that zoning. And right in the center space that you will see is actually what we call the central region, which further is being subdivided to core central region, which is your prime district, like your district 9, 10, 11 properties in Orchard, River Valley, Newton, Novena, etc. As well as the CBD downtown core area, as well as Sentosa zoning. These are under your core central region. Anything else within the central zoning that is not in the core central region will be classified as your rest of central region. Places like your Bishan, Marine Parade, your Pasir Panjang, Queenstown, etc. Okay, and we are actually using a 4 years performance to decipher between the time period of 2014 to 2022. If you were to enter in 2014 and sell in 2018, did the new launch TOP projects or resale condos in each region, which of them actually perform better? And then we further study in a rotating 4-year kind of time frame, meaning that if you buy in 2015 and exit in 2019, how does things look like? All the way until 2022. Okay, so why do we actually use 2014 to 2022? Rationale is because there is a dramatic shift after June 2013, where the government actually introduced what we call like the godfather or cooling measures.
Why do you call it the godfather of cooling measures?
Okay, so because actually in spite of the run up, of property prices, from 2010 all the way until 2013, where we introduced different additional buyer stamp duty, reducing of the loan to value, prices still keep going up, right? And it is only when total debt servicing ratio was introduced as a cooling measure, which essentially limits and controls how all the different banks is going to give and provide loans to assess the individual loan eligibility of all borrowers in terms of 3 components mainly: their income, your current loan obligations, as well as your age. So all your loans that is non-property will also be accounted for when you want to take a property loan, so that the government wants it to be prudent, as well as all information across all banks are being shared. So meaning I can't go to OCBC because they do not have my history of my banking loan history with other banks, and then they are able to give me a higher loan amount. So all these things, in short, right, reduces a lot of affordability, and it takes out a lot of speculators from the market. And you can see that actually from here, what it results is that there's a huge drop in terms of volume, and hence in the next 4 years after the introduction of total debt servicing ratio, we can see that prices have started to actually plateau downwards until about end 2017. Okay, and coming back to this, how did the developers actually respond after total debt servicing ratio was introduced? Because they also understand that nowadays everyone is limited by a budget, and in order to make sure the units can be sold off to the end users in a very healthy kind of take-up rate, the developers has also pivoted from building bigger units to actually smaller units so that they can keep the overall price quantum still affordable to most consumers. So in the new era, this is done by our research team, you can see that overall, the bedroom sizes have become smaller. So essentially, those that are less than 500 units, you can see that these are mainly going to be your studio units and a one-bedder, 500 to 699 square footage. This will be largely your 2-bed, 1-bath. 700 to 899 will be your 2-bed, 2-bath, and your 2+ study. And this is also the time where there was a larger introduction of what we call like a compact size 2-bedder, meaning your 2-bed, 1-bath. Because essentially last time mostly it is 2-bed, 2-baths. And this is another way to let the developer sell out and fulfill some investment demand as well, where they can, pay like 200,000 less for one lesser bathroom.
Right.
Okay. And the 900 to 1099 square footage is mainly your 3-bedder and your 3-bedroom premium, meaning those with an additional utility room for bigger family types. 1001 to 1299 will largely be your 4 bedrooms, and 1003 and beyond will largely be your 5-bedders. Okay. So I think essentially when we make this study, right, it's because we want to answer this question that people always ask us, which is, should I buy a new launch project or should I buy a resale project? Which one actually offers more capital appreciation? And of course, because I think this year we have like 38 projects that is coming up that will attain their temporary occupation permit, then there is a further segment where buyers will actually ask, then is TOP projects actually better in comparison to the 47 new launches or the resale projects?
Yeah.
Okay. So maybe let's start off with the East region first.
Yeah. And I think also just to share the context of our research as well. Yeah. So we are not going to talk about the intangible factors. Of course, there's intangible factors. For example, some buyers will always have criteria that they just want to buy new launch because they want to make sure that they enjoy different types of effects. For example, they want the progressive payment kind of opportunity. They also want to enjoy the fact that after 4 years of waiting period, once they get their keys, they belong to the first wave of buyers. So we're not going to talk about intangible factors like this. There's also another set of intangible factors, like, for example, TOP projects. Some clients, they do not want to wait, but they have a set of criteria that they do not want to live in a property that other people have stayed in before, which is why they always hunt for brand new TOP projects. Have you had clients like this
Yes.
that has this set of criteria?
Yes, definitely. Because I think one of the opportunity costs is like people cannot wait 3 to 4 years for like a newly launched kind of project, maybe because of their own family reasons. But at the same time, they will also want to not want to spend a huge amount of money on renovation. So like TOP project actually gives you that kind of sweet spot.
Yeah.
And the other thing is sometimes some buyers might be concerned whether I don't want to be bothered whether there's any housing history, because as a house is maybe 30 to 40 years in terms of age, right? They might be thinking, is there any major renovation issues? Are there any
leaking
loan shark issues? Were there any deaths that happened in the property?
Right.
Yeah.
So some of this intangible kind of preferences we'll not be diving into. So instead, we'll be diving into a few key parameters. Number one is that we want to answer this core question on the regions that Rong has shared about, and that if we can go back in time, at which particular year, starting from 2014 until now, should we have bought a resale, a new launch, or TOP project? And there's also another set of criteria is that we'll talk about these few things right here, is that we're comparing gains on a PSF level on a year-to-year basis over a chunk period of 4 years. So Rong, come bring us through.
Yeah, and to explain why you use 4 years,
right?
Generally, it's because number one, you will have cleared most of you will have cleared their seller stamp duty.
Right.
Because prior to 2017, seller stamp duty was a 4-year time frame, and most people would likely want to sell after the seller stamp duty is cleared to actually maximize their gains.
Yes.
Okay.
Yeah.
And of course, now we know that seller stamp duty has already been shortened to 3 years' time, and also like 4 years also allow us to actually have one more additional time frame that we can analyze in terms of like this research purpose.
Correct. And also for the purpose of today's research is that we will not be analyzing freehold property. So even for the TOP projects as well as the resale condos, we are only analyzing all the 99 years projects. All right. So let's go into the first region.
Okay. So you can see that we have largely classified not just broadly into like a resale property, because we understand that new launch condo, how we define is basically, in short, when you buy directly from a developer, in that year, for example, 2014, it is considered a new launch. What is classified as a TOP condo will be generally we are considering sub-sale transactions that happened before the completion of the property. So that usually ranges just before the project has attained TOP until about 9 months after it's attained TOP. And for resale condos, we actually further broken it down into like 4 different age range. Because people will be interested, okay, when I buy a resale, maybe I have a preference to buy something that is younger. So I want to look for projects that are actually age 10 and below. And when we talk about age over here, we are not talking about the age of the property, meaning that we are not counting it from the date that it has TOP, but we are actually counting the age based on when the land was actually being sold. Meaning this is how your remaining lease will be calculated, right? And then we have like the mid-size kind of age where the condos are between 11 to 25 years old, slightly older, 26 to 40 years old. And in some regions, we might be able to look at condos that are actually above 40 years, although like this category is actually very rare because generally Singapore is still quite young overall.
Right.
Okay.
Maybe it will also be good to talk about the years. So, for example, later there'll be a lot of charts basically with these big yellow banners. So basically, this means that if you were to purchase a property in the East region in the year 2014 and you exited just 4 years later in 2018, and coming back to the 4 year spectrum is that we also were deciding about whether should we compare a longer period of time, but we realized that the moment we start to stretch, let's say to 10 years, then the research basically will be a little bit more insignificant, because as we drag the investment horizon, naturally you have a higher chance of seeing gains. So we want to see some of the top performers within a 4 year region. And this is an illustration that if, let's say you were somebody that bought in 2014, East region, you exited in 2018, if you have bought a new launch right there, you will have seen a median 6.5% in terms of a PSF gain. And take note that within every percentage, there are outliers as well. Some will perform better than 6.5, some will perform lesser than 6.5, but on average in the East region, in this 4 year cycle, this is what we see. And of course, in the resale category that are older than 26 years old, 8.7%. So basically on this first chart, we just want to introduce you some of the key parameters.
Yeah. And also one of the reasons why we only want to use a 4 year range is because I think we are transiting to a new era where we want to see results faster. You know, like it is very different from, let's say, our parents' generation where they buy with the intention to maybe hold on forever or for many, many years, like over a decade, right? So nowadays, we are in the era where, okay, how can we actually increase our portfolio at a more accelerated stage? That's why 4 years will be usually something what consumers are looking for. Generally, you can see over here that for the first chart, Eastern region 2014 and 2018, you can see that the best performance, of course, goes to the resale properties of 26 to 40 year kind of range. New launch do pretty, they are doing okay, 6.5%. And I'll say that TOP projects and younger condos less than 10 and between 11 and 25, they actually do not perform that well. So if we go to 2015 to 2019, then you can see that, actually only the resale 26 to 40 years old perform well, about average percentage change of 12%. The rest, I would say that the performance is actually subpar. But of course, sometimes we need to look a little bit into the details, because sometimes when you look at the average result, right, what it means is that like maybe in that category, you have a lot of underperformers, right, that actually eroded the performance of like the good performers.
Right.
Yeah. So
maybe share with our audience for this particular season, 2015-2019 East region, what are some of the new launches that resulted in 1.7% gain?
okay, so in the context of the basket of new launches between this region, you can see properties like Coco Palm, Dines, Eco, U Habitat, Palm House, Q Bay Residences, Stratum, The Glades, Santorini, Urban Vista, View 8, Waterfront Isle. But of course, you can see that actually, in this basket of the new launches, right, we can use Coco Palm for example. Actually, Coco Palm has been is one of the top performers in new launches in that era. But however, if you just look from an average data standpoint, right, because the overall performance would have been sort of like muted by other properties that maybe didn't perform so well. So for example, like U Habitat, The Glades, in this kind of time region. And of course, we are talking about this specific 4-year time region, because if you have held on to these properties until today,
right,
almost every single project in this category, right, would have been
more than 10%, I believe. Yeah.
Correct.
Right.
Shall we move on?
Yes.
Okay. So for East region 2016 to 2020, we have the consistency in terms of resale 26 to 40 performing the best. And of course, how we look at this, right, is basically what it means is that like averagely, largely, most of the properties in this 26 to 40 region segment, as long as you throw a stone, your probability
you buy 99 years,
99
resale,
years, it will perform well.
Yeah.
But however, in the other segments, what it means is that it's not saying that there are none of any new launches or TOP projects or younger projects that actually do not give you a good price acceleration. But what it means is that like they are more selected, and you can of course use our HAPC, like PLB criteria to identify such properties that have higher appreciation kind of factors.
Right. And of course, end of the day, later when we sum it up, the key objective, just to keep gently reminding ourselves, is that we want to see whether history repeats itself and what can we learn from the past data to help us to make a decision, or whether does all this even matter. So later we want to answer that at the summary portion. How about 2017?
Okay, so for 2017, then of course the message is still quite consistent, 26 to 40 years old, and then we have the plus 40 years old segment. So maybe we can talk about to the audience, right, actually what are some of these projects that actually fall between this 26 to 40 years old kind of category, and why did they actually perform so well? Because in the eastern region, for example, 26 to 40, right, let's say in the 2017,
yes,
you realize that this basket of properties will consist of properties like Bayshore Park, Bedok Court, Lagoon View, Laguna Park, Loyang Valley, Mandarin Gardens, Tanah Merah. So they actually have a larger portion, right, of actually like District 15 properties. And I think like partially it's because like all these properties, they have a higher disparity in terms of pricing compared to the younger properties in the same district, and they are more popular. They are in a more like what we call the rest or central region kind of eastern region properties, where like people like to stay in District 15, and that's also one of the reasons why they perform well, because of the demand factors.
Right. And how about the last chart for the East region?
Okay, so of course in 2018 to 2020, of course, in general, everything performed pretty well. And one of the reasons that we can attribute to this is, of course, of COVID, right? Large printing of money.
Quantitative easing
by US. So when money flows and people start to shift, like their asset classes from more higher risk high volatility assets like crypto, as well as stock market, when they make the gains, they want to like reshuffle some of this money to real estate, and that's why there's a spillover effect. That's why we see very, very strong performance in 2021 and 2022. Right. And of course, just to talk about the new launches, you see 1.3%, right? In this basket, we also have seaside residences, which is an outlier. Yeah, which is also a high performing new launch within actually this time range as well. So we have based on transaction, we have the highest profit margin, 700 plus thousand.
For a two-bedder. Is that a two-bedder, a 2+ study?
753 square feet. Right. Yeah, but that is really a strong island, because it actually performed much better than the bigger bedroom types in seaside residences.
So maybe let's talk a little bit about the other projects within this basket, because seaside residences is one of the outlier that has performed extremely well. That's in, of course, D16. And then
Okay, so in 2018, new launch basket, we had Coco Palms as well, Grandeur Park. So these are still like generally strong performances. Of course, we have projects like Santorini, Tapestry, Alps Residences, which are located along the Tampines Avenue 10 stretch, where you actually have a huge supply of competition, you know, like for buyers to come in. So this, I would say that generally these projects, they will still have some price appreciation, but because of the strong competition with the neighbors, they are not going to get as much price acceleration as compared to something else in the eastern region.
Yeah. So just to mention about seaside residences, the annualized gain is in the range of
5%.
Yeah, plus minus about 5%. So because when it's mixed with the batch of baskets of comparison here, it's being brought down by the rest of the new launches. So of course, later when we summarize, the key objective of why we are spending so much time to do all this research on a 4-year basis over the last how many years was that? About 8 to 9 years. Was that this also helped us to look at some myths, because there's always been myths in the real estate market. I mean, sometimes you will hear myths like, you know, you can only buy new launches, no matter which year. New launches will sure help you to see appreciation, which is not true. And of course, there's also me saying that, you know, the best is, of course, to always go for resale, or the best is always to go for TOP projects, or the best is always to go for freehold. So if we were to size it down into a 4-year performance basis, sometimes it helps us to see the picture on a clearer clarity. And of course, if your time horizon is about 10 years per investment, then maybe this doesn't matter to you. But if you want a little bit more flexibility, in the sense that even though you might have a longer trajectory, after buying a property, you will tell yourself, hey, I want to stay and hold it for minimum 10 years. But sometimes when life event changes, after 4 years, you might have a motivation to move maybe to a landed home or a bigger property, or maybe you need to switch because of your school going needs of your children. Then this gives you a little bit more flexibility, because you know that you're buying something with more certainty. Yeah, so back to you.
And also, I think the other thing to note, just now we mentioned seaside residences like 5%, right? We are actually talking about annualized gain, right? So it is not 5% over a 4-year period, right? So it's actually like 5% annualized, meaning that if you use like a 4-year period, right, it'll be close to like a 20% kind of returns.
Great.
So this one is what we talk about is 1.3% over like a 4-year kind of period.
Right. All right. Now, so just a quick glimpse on the East region summary. This is the overall summary on this 5 different entry and holding period: 2014, 15, 16, 17, 18, and thus the PSF at the start and the end. And we have classified them by dark blue color, meaning the best performing, as well as the red color. So that's true.
So in summary, the color coding is a gradient of strength, right? So the darker the color of the red means like these are the worst performing, as well as the strongest, darkest blue is actually like the best performing, right? So you can see that actually, at least for the eastern region, for the last 8 years of study, we can attribute that if you are not very good with analyzing and knowing how to do property selection, you will be safer buying somewhere that is actually between 26 to 40 years old in terms of resale condos for eastern region. And just how we mentioned, some of these projects, they actually lie in the Bayshore area, District 15. And this is also one of the growth areas that we like to look out for due to the additional MRT station that's coming up in the Bayshore area. And if you look at the master plan itself, we see that actually there is a huge segment of residential land for future development that has been planned for, right? So most of the time when we have more supply coming up eventually, so what it means is also that it helps to uplift, you know, like the surrounding resale projects if the price disparity between the new launches versus the resale, right, the gap is huge enough, right? So it entices like the buyer pool to come in when the launches are actually out by the developers.
Right. Come, let's have a look at the Northeast region.
Okay, so Northeast region, I would say generally it is still a pretty young kind of segment. So you're not going to see properties that are like above 40 years in general. In 2014 to 2018, you can see that actually only the younger condos actually perform slightly better. Most of the TOP condos, for example, maybe you will be interested to explore why is this like a negative 10.7% during this 4-year period.
Yeah.
So let's look at what are the TOP projects that are in this basket, right? So interestingly, you have projects that are like Treasure Trove, Boathouse Residences, Central Residences in Ang Mo Kio, Cardiff Residences in Serangoon, H2O Residences, Coven Regency, Park Centrals, Park Vera, River Isle, River Sound, Terrace, the Greenwich, Luxury, Minton, Scala, Watertown. Right, so actually in this list of project, you realize that actually Treasure Trove has been a very, very strong performer. Even though now you see it's like 10.7%, so you have outliers like Treasure Trove. Let me see. Park Centrals also perform really well in this segment.
Right.
Yeah, so you have like segments that don't perform well, for example, like luxury, like H2O Residences, Cardiff Residences, Boathouse Residences. These actually have more muted growth.
Right. And partially, we also have to go back to the cooling measures chart. Is that during the 2014 to 2018 season, this was the period of adjustment after the godfather of cooling measures, right, that Rong has mentioned about. Basically, the TDSR measures came out in 2013. The market took a bit of time to get used to the adjustment in terms of borrowing capability, as well as the adjustment to ABSD and other cooling measures that has actually grown over that substantial period. So 2014, this 4 years, we'll say that is a recovery season for the real estate market. And if you were to look at the next one, 2015, you will see a very surprising change. So basically 2015, just about 1 year after the adjustment to the TDSR concept, it seems that new launches started to dominate.
And actually one of the reasons why is because in the transitionary phase of the June 2013, right, is that buyers and developers were caught off guard because nobody actually predicted that there's going to be this kind of cooling measure that happens, right? And developers actually maybe buy the land based on a certain research or study based on the potential affordability of their potential buyers. And they have decided that they're going to launch big units that are slightly bigger in units, for example, like Interlace, Sky Habitat and all that. Right. And when the cooling measure came in, they realized that, actually the demand has dramatically changed. And actually that's the beautiful and very interesting point about real estate. Yeah. Right? A lot of times when people want to say about like timing the market, right, is because they only really look at like the supply side of things. That supply side of things is very inelastic because it takes 3 to 4 years to create and fulfill the supply. Meaning I launch today, but my consumers can actually enjoy the supply, right, only when it becomes like a physical asset that can have key collection where people can start to move in. But demand can actually change dramatically overnight. And what we mentioned just now in terms of policy makers, right, they can actually shape how demand will actually move just by changing the policy. So for example, over here, the borrowing capacity detect that actually buyers now want to go smaller to keep it affordable, as well as we always also share that in scenarios where right now additional buyer stamp duty. Okay, so if today we wait, right, and the government decide that, okay, I think we will start to reduce additional buyer stamp duty for Singaporeans instead of 17% for your second home, and now we can drop it down to 5%, right? Then we will know that immediately the demand
will be activated,
will change overnight. Yeah. The demand will increase overnight, but however, the pricing will also adjust very quickly because if you are the seller, you will start to know, you will start to call your real estate agent who is marketing your place and probably tell them that I think we should start to increase price because there will be more demand that's coming. Developers will also change their price list as well. Yeah.
This is the same scenario as interest rates changes. So tomorrow, let's say we've talked about this a lot of time. If you open your newspaper, rates change from 4% and it dropped instantaneously to let's say 2%. What's going to happen is that every resale seller and developer, they will have a tendency and motivation to want to raise price. And this is because their mindset is that the buyers in the market right now is going to have an increased amount of borrowing capacity and buying power.
And I think like one of the important advice if you are a buyer, the focus should not be about timing the market, and the focus should be about buying the right property, buying the right type of property in the right segment, in the right pricing. The rationale is because, and of course with the in terms of using the right financial prudency such that we have the holding power, because as a buyer we always do not have the foresight to predict what's going to happen. But what we can do is to place ourselves right in the correct side of the investment where our risk versus reward, right? This risk to reward ratio is in favor to us from an investment angle. But sellers to a certain extent can time the market a little bit, because as long as you're holding power, the seller can always decide that, okay, I would not want to sell if let's say today is like an economic downturn. Yep. As long as I'm holding power, I can continue rent it out. I can afford the monthly installment when I'm staying in. I don't have to choose to sell in a bear market. Yep. And you always have the clarity to know that, we all know that 2021 is a good year because price has accelerated based on the based on the performance, and you can decide to sell that, okay, I think this is a good time for me to capitalize on whatever gains that I have. Of course, we also would not know as a seller standpoint that will it still go up further and how much more it will go up. But at least you will know that are you comfortable with the current profit margins that you can get if you were to exit today.
Yeah. Okay. And a clear example of this is that whenever if we look at the amount of inventory in the market, I think we talked about this during one of the NOTG banter, was that the amount of supply in terms of the listing supply, if you head on to some of the portals, for example, like Property Guru and all the famous portals, you realize that sometimes in a bull market, more and more people will want to put their listing in the market. But when there's negative news, for example, risk of global recession, there's a war ongoing in certain countries, there's interest rates hike, you'll find that sellers that have holding power, they will find that they are demotivated to put their property in the market. They would rather just pull off their listing from the market. They will wait for good news because they want to wait for a season where the buyers on the streets, basically the buyers that are waiting on the sideline, have higher purchasing power. Then they want to put their listing in the market. So some of the combining factors is that when you see volume dipping, when there are global macro kind of risk factors, this is also because of the behavior of owners that have strong holding power, and there's no need for them to sell, which is also the reason why in like the last few years you seldom see fire sale. You also look at maybe like auction, the traditional method of selling homes. You look at auction kind of properties, a lot of them are actually voluntary auction. They are not really like the mortgagee sale in the past. So coming back to this, actually a very stark example will be to look at these two developments at Bishan. One is Sky Habitat, one is Sky View. Both properties are owned and developed, were owned and developed by Capital Land. But Sky Habitat was actually constructed with the concept before TDSR was implemented. And Sky View was constructed after TDSR was implemented. And Sky View, basically the size of their 2-bedder is equivalent to Sky Habitat's 1-bedder size. And of course, if you look at performance, Skyview, the owners that bought in the Skyview, they enjoy a much faster gain. Not saying that Sky Habitat owners lost money, but they took a longer time to hit that kind of appreciation that they're looking for.
And then I would say that the direction is very, very different also. For example, like Sky Habitat, I would say in terms of architecture is really iconic. We have an iconic architect that work with the developer to create like this facade very that I would say is very, very unique. And Skyview, generally it will be what the developer, I would say that like selling what is practical, selling really what like the demand is required in terms of like the quantum play,
right,
as well as functional layout, and no fancy, I would say like in terms of architectural design. Yeah, but it gives a strong performance.
Yeah. So you will share with our audience what are some of the new launches during this season, 2015-2019, Northeast.
Okay, so 2015 to 2019, Northeast, we see a strong performance like Botanic at Bartley, High Park Residences. Right, so High Park Residences definitely is a very, very strong performance. So sometimes people always, I think in real estate standpoint, they always mention that, hey, I think location is the most important factor in terms of profitability, right? And usually I like to like debunk this myth that usually. So what are some of the factors that people will think is a good location?
Yeah, always talk about it has to be in the prime district, or it has to have very good schools. It must be very near to the MRT station. But High Park Residences is really one of the outlier because it is really about an entry price play.
Yeah, right. It's not near any MRT station. It's beside LRT. It's in Sengkang,
right?
Outside Central Region. But then it performed very well because it was launched below 1,000 per square feet. And so one of the conclusions in terms of this kind of case study is to understand that actually to be able to understand a correct entry price is more important than to understand just purely by buying based on location. But of course, this framework I always mention that can only be applied in Singapore properties, because no matter how ulu we think a location is in Singapore, it is still highly populated, which means that there is demand that will actually be your potential exit audience. Yeah. Compared to if you were to go and apply this in overseas property, let's say in Australia and all that, ulu regions are really very ulu regions. Maybe you have a township that is in terms of population of like 1,000 people, 2,000 people. Yeah.
And I think during that season in 2015, what a lot of people didn't realize was that High Park Residences was in a new town. And of course, there's this new town theory whereby Fernville is the new town. Canberra is a new town. The performance of new towns are very different because there's a lot of younger demographics family that has bought into the BTO, MOP'd already, and they see a substantial gain in their entry BTO price to the exit MOP price of their HDB, and they are in the demographics of their early 30s. They have higher purchasing power, and thus new town performs very differently from a matured OCR HDB town as well sometimes. Right?
So I think in summary, it's a new township effect. Essentially, it has the demographics of high mobility owners, meaning they still have the aspiration to move. They are in the good income range to move, and they are in the younger age where they find that they can actually. There's not so much friction as compared to as in when we go older, we have more concerns.
Yeah, because when you're 40s, 50s, you're entering the defensive stage.
Yes, correct, right? So you are still more in the attacking kind of stage, right? In the more offensive stage. And also, importantly, it's because new township, because of the BTO effect. You know, like BTO is also very important. In our mode analysis, we always mention about exit audience as one of the primary factors, because BTOs, if you are looking at like outside central region kind of condos, right? If you have a lot of BTOs in that region, what it means is that like you actually have a huge amount or higher amount of high profitability upgraders. And when people has already profited from their properties, it's easy for people to think how they can utilize the equity inside their house to make a better move for themselves and for their family, whether is it from an own stay perspective or is it from an investment perspective. Right. Compared to if, let's say, I am owning a resale HDB, for example, owners that enter in 2011, 2012, all the way until 2020, actually, most of the owners are sitting on like averagely -8 to -10% loss in terms of their home equity, in terms of their housing pricing, their HDB. So it is very hard, number one, for people to accept losses to go into a better situation, because we don't like to take losses. That's point one. And point two, even if I'm willing to accept the losses, my down payment I have to fully come out the down payment for the next house purely based on my ability to save.
Right.
Yeah, which is actually much tougher as compared to if I know how to position myself in a good property, the appreciation has helped me to build up the down payment for the next better house. Right. So it's very, very important to have the correct property selection.
Right. So I think for Northeast, let us shift to these last three charts very quickly. So basically for 2016, resale that is in the older era dominates. The older resale dominates in 2017, this 4-year spectrum as well. But of course, as you can see, the trend starts to show itself in the sense that as we move into the later season of the pandemic that starts from 2020 sort of already sort of like guarantee a certain percentage gain in most regions. Later, as we move on to the final portion, we're going to summarize close to about 16 different observations that we have. But similarly for 2018 to 2022, you realize that the older resale properties, even in the Northeast region, also dominates in terms of percentage gain. Maybe you want to share with us a little bit about this. For 2018, Northeast, what are some of the old ones that dominated?
Okay, so of course there are like certain outliers. For example, like Chuan Park, right? So sometimes you see like older properties that perform well is because they actually went into the en bloc. So they are actually being bought over, and that's why they had substantial gain. Of course, Chuan Park is interesting in the sense that because it was actually en bloc successfully. However, there were investigations where there was some other foul play, and hence they are now in a legal case, and the en bloc is actually sort of like on hold, on shelf. So of course, in the 26 to 40 year kind of region, we also have Far Horizon Gardens. So when you are in an older condo in a new township, you also can benefit from a new township kind of effect because there is a rental transformation that is going on with new MRT station, a lot of new launches going there, and sometimes for much older condos, again, you know, like it shoots up like a huge price disparity, and hence it could make sense for you to consider such development. Of course, that will be depending on your own kind of like a risk profile as well.
Right. Okay, so we'll move very quickly through the North region. Basically, this is 2014, and of course, North region for this very first chart is going to shock a lot of people. So maybe let's talk about a little bit about this new launch category. Why is it that there's a minus 17.5%?
Okay, I think in the northern region, same thing. There are only 2 new launches that fall into the category. In this time period, which is actually 9 residences, which is a mixed development, as well as a Skies Mutonia. Right. Generally, I would say that overall their launch price is pretty high for that era.
For the season.
Yeah, for that season, yes. Right. For that season is a better
But now they have already seen gain.
Yes, of course.
After holding for 9 years from 2014 until 2023. Now, of course, 9 residences owners, Skies Mutonia, when they exit, they have seen positive gain. But of course, if during this 4-year season, if they would have exited, they will see a negative kind of result.
So I would say unless you really buy into a dart, I would say that like time can heal some wounds, can heal most wounds, even if the decision of property selection is not the best. Yeah. So you can see actually from a property investment angle, number one, we can see that holding power is definitely the one of the most important kind of thing. Yeah. Especially when the property selection is not like the strong suit.
Yeah. Okay. So if your property don't perform, if you're holding power, of course you can wait for the recovery. But what we're trying to achieve over here at this webinar is that if there is a chance or a method or a methodology for us to select something that is having a higher probability of being a winner in a 4-year horizon or shorter time frame like 4 to 5 or maybe 6 years, then is an added benefit that we will all want to have, right?
And I think something to add on, of course, like for the northern regions, in this season is because there are a lot of new launches that coincide with executive launches in the northern region. Right. And we all know that actually brand new executive condo launches, they already have a substantial pricing discount compared to new launches in that same era. So partially, because if let's say for example, right, the EC in this era, probably their launch pricing is about $700 odd per square footage. And for condos, in a similar kind of time frame, they will be in $900 plus to about like almost close to like 1,002 kind of PSF. Yeah. And so when you are buying a condo in the northern region where you already have a very, very strong disparity, right, compared to the EC, when the EC reaches its MOP, it can sell at like a similar price point as the entry price of the new launches, and hence you realize that it is harder for these new launches to exit at this kind of short time frame, right, to actually profit.
Right. All right. So of course, for North region is a little bit different because we are seeing negative, and then in 2016 there was a turning point. So sometimes in different regions there are also different seasons. So in a particular year, maybe going to a separate region will be a better choice comparing to maybe, for example, if you have always been a north lover for many years. But this is only provided, just to disclaim again, that if you are looking at a 4-year ROI perspective. So 2016 was a turning point for North region, because over here you can see that the new launches started to perform, and then similarly over 2017, new launches and resale, and then across the spectrum 2018, all are winners in the North region. Maybe talk about some of the winners for 2018 in the resale market, or maybe let's talk a little bit about the green bar, the TOP projects for North region 2018.
2018.
Yes.
2018 TOP.
Yes.
Okay, so 2018 in summary, if we were to go back in 2016, right? Why all these started to perform well is because actually one of the top performers would be North Park Residences as well as Wisteria. Of course, North Park Residences is an integrated development, expanded in terms of the shopping mall size, so that it becomes like the northern region's biggest retail kind of development with residential on top, and you have an underpass that actually goes towards the MRT station. It integrates with the bus interchange as well. So over here, same thing for the TOP in 2018. Also, they also belong to your North Park as well as your North Park Residences, which is the integrated development that we mentioned at Yishun MRT station.
Yeah, even though if somebody were to buy it at TOP, they still see a gain. And what this means is that if the first-time owners were to hold it all the way from 2016 to 2022, they will have seen a total cumulative gain of even higher percentage. But when you see a strong project like this, even when you buy a TOP, that you still see a substantial amount of gain.
So I think this can also answer the concern of some owners might be some potential buyers that might be looking into some of the TOP projects that will be coming up. For example, Riverfront Residences or Momentum Park. Or your Treasure at Tampines, and they see the past transaction data and say, oh, if I actually buy at this kind of entry price today, the first owner will have already profited actually 300 plus per square feet already. Is it very risky for me? Right? So to answer this question, I would say that if your property is positioned correctly in terms of pricing at the right region, you will still be able to enter at a safe kind of pricing entry price, and you can still, if let's say there are more transformation factors in terms of or price disparity as compared to pricing in the similar region, you will still be able to look at more price gains.
Right. Yeah. Maybe let's talk one such project, 11 to 25 years. What is this?
11 to 25 in 2018. 2018, 11 to 25.
Yes.
In the northern region, of course, we have Orchid Park condominium.
Right.
So it is just opposite the reservoir.
Right. And
one of the very, very old projects over there. Which usually I used to joke about this kind of properties that are really old, is that if you bring your friends from overseas to Singapore and you drive past, they wouldn't be able to tell whether this condo is actually a HDB or is actually a condo, because the newer HDB actually look much more pleasant from a facade standpoint.
Right. Yes.
But of course, I think from a real estate investment angle, number one, I think broad-based kind of advice is sometimes if you are very attracted to very shiny kind of objects, very luxury developments, sometimes they might not give you the best kind of pricing performance as well. Yeah.
So even older projects like this, you can still see a 20% gain, which is pretty fantastic for 4-year season. Okay, we're going to move and skip through the West region. So we want to come to the RCR region here, as well as the CCR region. And then I think a lot of our audience are waiting for this final chart. Why don't we come to this final chart, and then we can shift back and forth a little bit, and then we talk a little bit. So maybe let's zoom in to
rest of Central region,
RCR and CCR, using this 10
overview.
Yeah.
Okay, I think rest of Central region has been a very strong performer in the last 8 years, and I think that RCR, I think they are in a very, very strong sweet spot. Rationale is because if number one, sometimes people will think that if I stay in the outside central region, meaning your east, west, north, or northeastern region, right? Sometimes people might find that in terms of transportation and convenience to the schools or to like the workplace, they are not as convenient, right? So actually, RCI is what I always call like a blue chip kind of area, because you have very strong demand because it is in very accessible locations, but you are not going to, how do I put it? You are not going to like, you don't need to like pay
for the CCR pricing.
You don't have to pay for CCR pricing. But in terms of like your convenience and location, right, it is not too far off.
Yeah.
So from a marginal value effect, rest of central region actually is a good performance in that range. And you can see that actually for new launches in Asia, they definitely do perform well. Even older properties in the 26 to 40 region, they also actually perform relatively well. So they have the most kind of like winners.
Yeah. And I think you'll be very interested to know how we finalize and tabulate this grid here. So basically, what we did was that we put in summary for everybody, as long as there's an average gain of more than 10% in 4 years, we'll put the particular type of property right here. So for example, to summarize for you, in the East region, 2015 and 2019, more than 10%, you only see one category, which is the resale that is between 26 to 40 years old. And of course, for CCR region, 2015 and 2019, the new launches is the only category that sees more than 10% in 4 years. And as you move downwards in the CCR region, 2018 and 2022, in the last 4 years, these two categories in the resale category see more than 10%. And if I were to move back here, you realize that why is that so is because this new launch category sees a minus 5.8% over here. So we'll also include this in the freebie PDF pack for you so that you will be able to have this as a quick reference. And maybe let's summarize this for our audience. Like, what do you see from here in terms of busting several myths?
I think in terms of busting several myths, I would say that generally, I would say that maybe it is not that like resale, you cannot actually profit. And also like not all new launches will definitely profit. Right. And I want to share one thing in terms of framework, right? Because maybe the audience might be wondering, hey, actually 10% in 4 years is not very exciting, correct? So I actually want to mention about this 10% in 4 years. 10% in 4 years, we are talking about this is in terms of property price increase in 10%. Over 4 year period, meaning that actually 1 year is about 2.5%. And based on one of the financial model that I actually put in, is that if you have a property that can appreciate at 2.5% on an annual basis, over a 5 year period, right? If you can actually enjoy a doubling effect in terms of your asset prices. The reason is because assuming that we are maximizing loan, meaning that we are taking 75% loan, if your property appreciate by 2.5%, if this is an investment, you actually enjoy 4 times the return, meaning your money will make 10% in a year. And that is how you can enjoy a doubling effect in terms of asset prices over a 5 year period. This is also accounting for the principal paid that will have been accumulated in the same 5 year region. So the equity will have built up. The equity will have doubled, in a 5 year region, which allows you to buy into a property value that is twice the original value that you started off with. So what I want to mention is do not look down at this 10% because we are in a leverage format. And if you know how to do even better and stronger property selection, you will be surprised that actually we have a performance where the return on equity, meaning that the capital that has an increase in value on a year-on-year basis, can be around 17 to 20% year-on-year. So which actually is very, very comparable to, stock picking as well.
Okay, Rong, talk a little bit about why we use a 10% illustration.
Okay, so I think a lot of consumers, when they are looking at the chart, you might be thinking, 10% over 4 years is actually not very exciting, right? Because it will only be about like average, like a 2.5% kind of return. And if we just go on to the next slide, because real estate, we always believe that real estate is beautiful because we are able to take a loan and we are able to make use of the leverage effect. So assuming that we fully maximize the loan amount that we can get, which is 75% of the property value. So what it means is that a 2.5% gain in the property value will translate to a 4 times effect, which means a 10% gain on an annual basis on your down payment that you have put into the property itself, right? So maybe we use an example of a $2 million property, and 25% down payment of this $2 million property, you came out with $500,000. And assuming that this is a purely investment kind of asset that you also be renting it out, we are not even consider the rental element in this context, which generally assuming that the property only keep pace with inflation rate of 2.5%, you realize that over 5 years' time, the property would have appreciated by $250,000. And during this 25-year loan, you will also be paying monthly installment, which a lot of times most consumers will think of a monthly installment as a form of pure expenses. But actually in your monthly installment, we have actually split into 2 components, which is principal paid as well as interest. Interest definitely, it is an expense, which if let's say this is a purely investment product, you'll be renting it out. The renter will actually fully cover your interest, so we can strike that off the picture as well. Principal paid is basically you can classify as your savings, and I always like to mention that monthly installment is the best form of dollar cost averaging into an asset class, because by hook or by crook, you will never miss your payment because you don't want the property to be foreclosed by the banks. So in other asset class, in order to continue the dollar cost averaging over a consistent long period of time, you need very strong conviction to not miss out the dollar cost averaging.
Right.
So in the context of principal pay, even though we are in this context, we are using 4%, which is representative of the current interest rate today, and assuming you can lock in the interest rate even at like 4% for the next 5 years, right? Your principal paid component will be 194,000. So just think of this as the additional equity that will build up in this house, and it will come back to you when you were to sell the property away, right? So in summary, in the 5 years time that you're holding this $2 million property, you have achieved a 250K capital gain based on a 2.5% appreciation rate per year, 194,000 of principal paid. So it would have actually helped you to gather 544,000, and not to forget that your initial capital outlay is only 500,000. Combining the 544,000, you'll be able to buy the next property at about $3.77 million. So it is almost you are able to double your asset prices just by having a 10% kind of appreciation rate over like a 4-year basis. So do not look down on like the 10%.
Yeah, do not look down on basically like a 2.5% asset price inflation version.
year.
So in summary, when you exit this after 5 years, just on the gross before letting off your legal fees, your agency fees and stuff like that, you'll be able to encash out close to about 900 over 1,000 right here, and that can be used as the next set of down payment for your next higher quantum property. So basically, this is a combining process of a forced saving through here, whether you are the person that is paying the monthly installment, or you rent it out, having your tenant foot the interest and portion of the principal payment on a monthly basis. Combining this effect is actually very powerful, and compared to just waiting at the sideline in the market.
And this is assuming that we are looking at properties that are only giving you decent performances.
Right.
So if you use our mood analysis, our HAPC factors, essentially we are able to identify properties that have like 5% kind of annualized gain. So that will translate to 4 times kind of rate, which is like up to like 20% return on your down payment actually on a yearly basis.
Yeah. And so in the free PDF pack, we're going to combine some of these key features right here. And that will then give you a better understanding and summary on if you're out hunting properties in the market. Of course, later at the end, we'll come to some of what we do, some of the things that we do for our clients on our consult level. And moving very quickly into the final segment is that we're going to zoom in on a district level on 99 years property. On this 3 particular kind of products, basically new launches, TOP projects, resale condos with high volume. So we are unable to compare all the resale properties within the district. So we want to zoom in on some of the very popular resale condos in every particular district. And hopefully this can craft a little bit of insights on the disparity level right now. And then we'll promise you to summarize for you right at the end. Okay. So District 1, basically, let me kickstart and then Rong can chip in a little bit as well as we move along. So basically, if you see the red bars, these are the rough indicative launch prices. Of course, these are all estimate. We final discretion, we need to put a disclaimer here, it belongs to the developer. We're not sure what will be the final launch price, but basically resale, these are based on the current highest PSF done in the last 6 months from March 2023 counting backwards. And new launch pricing, we are just putting an estimate based on a 20% profit margin from the developer estimated break-even prices. So TOP, if you see a dark blue, for example, like this, these are based on the Property Guru listing prices as of March 2023. Yeah, you.
You have covered what I'm
Okay, so District 3. Okay, so maybe just to share a little bit like in terms of insights. Now, when you see this, let's say you see Avenue South. Avenue South TOP.
soon.
Okay, so it's going to TOP. Based on the current asking price on Property Guru, asking price averagely median out at about $2,300 per square foot. And of course, when you see resale right now at Echelon, Principal Garden, they are going at this range. So what is the disparity between these two kind of products? Maybe you can share a little bit.
So I would say that generally when over here, when you don't see like the disparity being like a wide enough gap, then usually it could be represented that the newer project, in this case the TOP project, right, might present as a better value kind of purchase.
Yeah.
But of course, we are just looking it from a very surface level, from a per square feet kind of a comparison. Of course, we have to deep dive into each individual project versus project, right? Whether their layout, whether the exact location attributes are similar, and then we need to make further adjustment to see whether that kind of like pricing disparity or pricing closeness justifies which product is
and we haven't looked at specific bedroom types in terms of quantum play as well.
Yes.
Yeah, so for example, certain projects in terms of the 3-bedroom quantum is very different.
Sky.
Yeah, it's very different from the quantum for the newer projects. But on a PSF level, when you see a newer product having the same PSF as an older product, the natural instinct is that, hey, is there an opportunity for the newer product? Should I go for the newer product? So maybe let's have some closer comparison. So let's have a look at District 15. So for example, Tembusu Grand was just launched, average out at about $2,500 per square foot. And if you compare this with the resale one, then of course on the PSF level, you're going to see a disparity. But of course, there's also many other factors and a host of other factors, is like the age of all these properties. And maybe a better example would be looking at Seaside Residences. So Seaside Residences has already TOP for a little while. Resale status right now, averagely asking at 2.5. And when you look at Tembusu Grand, also at about 2.5. Then on a PSF level, it might seem that going for Tembusu Grand will be an opportunity that you can consider, right? So let's come to District 18. And just to give an illustration of usually how we help our clients to look at the disparity effect. Treasures at Tampines, basically current asking prices on Property Guru, average out at about 1,007 plus per square foot. And now if you compare to one of the newest resale products in District 18, Alps Residences, the highest PSF transacted over the last 6 months is at 1,699. So when you look at this, there's only like close to about a $29 to $30 per square foot difference. And when you see that, it means that the disparity is actually very, very lean. And that might present an opportunity that if you were to go for Treasures at Tampines on a PSF level, it might make more sense from an opportunity angle. Because what this means is that this is a brand new product. This is already a resale product for a couple of years, but it can still do so well. What does it mean for this brand new product when it hits its full TOP status? Because this is not at the final TOP stage yet. This is basically at the sub-sale level at this point in time, but it's already transactions going on. So this might present a better opportunity if you're hunting in D18 from PSF angle. And this is just an illustration of how we usually deep dive. But usually on a consult level, when we deep dive for our clients, we compare across board on 99s as well as freehold, because sometimes freehold projects do have a very interesting opportunity for us to enter as well.
And I think just caution to the audience is that when we mention specific projects, they are not actually product recommendations, because end of the day, the same project can be a good fit for person A, but a bad fit for person B. Rationale is because from a portfolio standpoint, we want to look at fundamentally what is the goals that you are trying to achieve, what is your time horizon that will be in the market, as well as your risk appetite, what is your financial resources, and strategies that you should be implementing based on which region you should be entering. Then we actually finalize on like what is the kind of property type that is the most suitable. So it could be that Treasure at Tampines could be the best fit for person A, but it could actually be the fifth best option for person B. So that's what I'm trying to say. So when you do a personalized consult, then that's where you can make the most effective kind of decision in terms of portfolio planning.
Yeah, and of course, at the end of the day, it also depends on whether is this your first or your second property. Because first property, I think we need to also weave in terms of personal preferences as well. There might be certain districts that will favor your family because you are hunting for a specific school for your kids to enter into, or maybe that there could be a level of familiarity with a certain region as well. So we also want to have a certain level of empathy because at the end of the day, first primary resident property is very important for the growth and of course the happiness of a family, right? So you want to make sure that this is something that your spouse is agreeable, both of you are happy with the decision, your kids are not having to travel very far distance to their school. So I think some of these things are what we have trained our consultants to really have a bird's eye view so that we can give proper recommendations. Now, we want to move very quickly into this final portion is that what will happen in the next 5 years? Now, because end of the day, if we look at this key summary portion as well, is that we'll start to realize that there's no quick answers to whether should you go for a new launch, a TOP, or a resale, because it seems that every season, in every region, there are different performers. So what can then happen in 2023? And I think the answer will lie on a very detailed kind of calibration based on which district you're after. And this is basically just a very quick holistic calibration just based on 99ers property. And what we do for our clients is that if let's say you were to come down on a one-to-one basis and we deep dive into certain districts, and for example, let's say you have already looked at District 5 as a key choice that you want to explore very deeply, and you're doing a sell and buy at this primary season in the year 2023, our consultants will then deep dive into D5, into particular projects based on this kind of formula and framework, and we will also plug in freehold options as well. But of course, using our mode analysis, there are certain other key parameters. For example, we usually recommend projects with a certain sizable volume, certain sizable density. We look at parents' attraction factor, we look at the ballast curve factor, and of course, after weaving in through the disparity effect and mode analysis, based on this disparity kind of framework, we'll then pick up the 3 projects that we think will have a higher kind of appreciation metrics to perform in the next 4 to 5 years in terms of ROI that we have been talking about. So this will be the base framework that we'll work with every one of our clients in the consult level. And then we want to also understand the final season is that there are 47 developments right here, 38 projects that were TOP, but based on what we have done is that we are able to plug them in on a district level, and this will then give us a clearer clarity, because sometimes when you look at the overwhelming 38 projects and 47 new launches, it becomes very overwhelming on what to select. But when you zoom in on the district level, it provides a much clearer view if you are very firm on a condominium kind of decision. So last but not least, we also use a tool called the PLB Lease Reset Calculator, and this is just an example how we have actually help our clients to analyze back then for Amo residences, because after doing a reverse calculation based on the two strongest competitor around the region of Amo, basically this is a clear green sign that this is an investable product. And of course, that's also one of the key reasons why Amo residences have done so well, because after resetting back to a full 99s, we realized that actually the disparity is so close. If you look at Thompson 3, after we reset back to 99s, a full 99s from its original tenure is actually presenting in today's asking price at $1980 per square foot, and Panorama is at $1963 per square foot. Of course, Amo is averaging at about $2083 per square foot. So when you look at the disparity, it is extremely close because they are less than $100 per square foot difference from one another, and that is a green light for entering into Amo residences. Of course, some new launches has a far wider disparity, and then that will then create opportunity that you should actually go for the resale counterpart or the TOP project. Now, to sum it up, we want to select the project with the highest appreciation potential characteristic. Our investment methodology is to buy the right thing in every season. It is not to stay out of the market. It is because in Singapore it's very different. And we always share with our clients that you should not time your primary residence. If you are still not owning any property because perhaps you have already sold in the last 1 or 2 years and trying to time the market because you were hoping for a global or Singapore recession, the best is still not to time the market, because whether you're currently bunking with your parents, you are renting a property, there are opportunity costs when you stay out of the market, because asset inflation is a very real thing. Your money that is left in the bank is deflating on a year-to-year basis, because always remember that currency in terms of the overall money supply is depreciating, because there's more and more money that is being created in the money supply M2 level. That's a whole new other topic altogether. But most importantly is that if it's your second or third property, then yes, you might have a little bit of liberty to try and hunt for the right one. You have a little bit more time. But if it's your primary residence, do your best not to time the market. Our investment methodology has always been following these 4 techniques, basically trifactor, mode analysis, micro segment targeting, and of course disparity effect. And mode analysis is one of our key tools that we develop in-house. It helps our client on a macro level to select projects based on scoring. And of course, volume effect is one of the key fundamental within mode analysis. And just a very quick glimpse of our PLB methodology again is that this is our entire team that's made up of PLB Media as well as PLB Realty. Myself have been in the market for 16 years. It's my passion to analyze real estate. And of course, personally, I've filmed more than 926 home tours. And I still love what I'm doing today together with our team of very experienced full-time sales consultants as well as our media and HQ teammates. And if you have not seen our YouTube channel, head on to our YouTube channel, look at the different types of playlists, enjoy the different types of home tours. Within each home tours, we also analyze different types of so-called methodology for different types of properties as well. And we also have our article segment on PropertyLimBrothers.com. You can read out on different kinds of articles, analysis. Properties for sale are actual exclusive homes that we're representing our home sellers. And we have 3 different tabs, basically condominiums for sale, landed for sale, as well as HDB apartments for sale as well. So these are just some examples of our innovation that we have populated over the years. This was what we have done over the last 12 months by developing very deep 3D architecture visualization to help our home sellers position their homes very differently. And just an example of this landed home is that whenever we want to share certain key things of how to construct certain things, this can be then visualized without buyers actually traveling down physically to view the home. So that not only benefits home sellers to position their homes differently, it also saves buyers time, and it allows the whole home property purchase transaction and selling experience to be more transparent and also more innovative, and it saves everybody's time as well. So just an example of also like how we innovated to solve certain obstacles within landed homes, as well as internally with like virtual staging, how we can then share different concepts as well. Last but not least, if you have noticed, our style of webinars is very different because there's no products push. It's basically knowledge sharing. We hope that you enjoyed today's session. And in the event, if we were to have any kind of collaboration with any developers, we will say upfront in the title of the webinar so that you're aware as a consumer. And of course, we focus a lot on our relationships. Do have a look at some of our chit-chat sessions where we chat with our actual clients for them to give us reviews on the service level as well as our experience level for them. And most importantly is that we don't believe in a one-man show agent model. Our consultants are full-time and they focus on the customer experience as well as giving deep analysis and advice through the entire selling and purchase experience. Through our methodology as well as our team model, we have been able to achieve very good results in terms of selling speed as well as selling price for our clients. And these are just some examples of our signature series and as well as our methodology, because we want to select how our clients, not just to sell their property at a maximum potential, but also to select the next property with the highest appreciation potential characteristics. Great, we hope that if you have been in a dilemma situation, we hope that this webinar number 5 have added value to you and given you some clarity whether to go for a new launch, TOP or resale property. But I think the most important takeaway is that come for our consult session, because through that, then you have greater clarity, because there's so much more research to be done on the district level and of course on the personal level as well, based on your investment entry range. We hope that we have added value to you, and we hope to see you on the next webinar, webinar number 6.
So the reason why we do so much research analysis of our clients is so that they can use the most effective strategy to leverage on their capital to build the best portfolio that they can.
Right. And yeah, we are very excited to have you on the rest of the webinar series on the rest of 2023, because the very next one, what are we talking about? I think it was Cluster House, right?
No, the art of TOP.
Oh, yes. If let's say you are holding on to a project that's going to hit its TOP status, what should you be doing? Should you sell before TOP, at the TOP date, or maybe about 9 months after TOP? Which one would be a better decision? And of course, if you intend to put your property in the market, your TOP property in the market, what should be the best way to market your property for maximum exit potential? So sign up for the next webinar on our webinar page. We hope to see you very soon. Take care and
have an awesome weekend.